Well, HCL Tech results are expected tomorrow morning, and in fact expect a strong quarter from HCL Tech as well, just like what we have seen from the rest of the IT pack so far. In fact, the revenue growth is likely to be ahead of the guidance. Eaton up poll suggests the revenue growth in constant currency terms at 3% versus the guidance of nearly around 1.5 to 2.5% on a sequential basis. This guidance the management had shared in the last quarter results. In fact, if you look at the overall results, there is expectation of strong deal momentum for HCL Tech as well. So far, we have seen a very strong momentum across the board coming in from Wipro, TCS as well as Infosys, and we have similar expectations from HCL Tech as well. EBIT margin is likely to remain largely stable on a sequential basis. Good amount of uptick is expected on a YOY basis, and overall the commentary from the management is also likely to be positive, with an expectation that maybe we should be seeing an upward revision to the guidance that they had shared in the last quarter. In terms of the numbers, well, the dollar revenue growth is seen at 3.4% on a sequential basis. Dollar revenue of $2592 million is expected. EBIT margin is seen at 21.4 to 21.5%. A slight downtick of 10 bips on a sequential basis, but a good amount of expansion there on a YOY basis. The impact of the wage hike is likely to be offset by improved utilization, operational efficiencies, and also improved digital mix. Kotak analyst does estimate that the profit growth is likely to be slightly lagging the EBIT growth on account of the difference in the tax rate. This is on a YOY basis, and hence Kotak expects that the tax rate is likely to increase during this quarter to 23.7% versus around 18.5% in the same quarter last year. Key monetable would of course be the overall guidance in the last quarter. Management had guided for a revenue guidance of 1.5 to 2.5% for Q3 and Q4. Edelweiss expects the revenue guidance to be revised upwards to 4.5 to 5% on a sequential basis. Last quarter, management had shared the FY21 EBIT margin guidance also at 20 to 21%. There is a possibility that we may see some amount of marginal upward revision to that EBIT margin guidance as well. Kotak analyst, who is Kawaljeet Saluja, does expect that we should be seeing a strong revenue growth, which would be broad-based across IT services, ERD, and products, and growth would be partially aided by large deal wins and continued momentum in executing digital foundation deals, and hence watch out for the entire commentary here in terms of the strong deal momentum demand across verticals and across mode 1, 2 and 3. Kotak also believes that the capital allocation is an area of focus because HCL Tech has been slightly non-committed in terms of the payout policy, and well as the payout has been slightly lagging the peers. So yes, that would be probably one key area for focus for HCL Tech. And yes, as I said, that an upward revision of the revenue as well as EBIT margin guidance is expected. Besides that, of course, watch out for the management commentary in terms of the outcome of the annual budgeting exercise that they have with the clients, the commentary in terms of the client pricing strategy there, the deal momentum, tenure and pricing of the deals, and also especially the commentary in terms of the overall how the product business is shaping. The street is not really as enthused in terms of the management optimism on its resilience. Will the company continue its aggressive M&A strategy or not? That would be another key area of focus. So yes, as of now, if you look at the stock, it is already hit fresh record highs post the TCS results. It's gained close to around 10% in the month of January itself, and it is trading at nearly around 20x FY22 price to earnings multiple. So any upward revision to the guidance and any positive commentary from HCL Tech would also be viewed very keenly from the investors.